This is Randy Alsman. I'm one of the members of the Investment Policy Committee here at Donaldson Capital Management, and I was going to be giving you a little bit of a summary of our meeting today. I apologize, by the way, for the sound quality here. I'm actually on the road heading out to meet with clients and calling you from the road, so you're getting a little bit lower sound quality than we'd like to normally provide you, but did want to get these notes out to you on a timely basis. Last week, Greg took you through our takeaways, and you'll probably be hearing from, eventually, from all of us on the Investment Policy Committee over the coming weeks. We'll try to give you a variety of voices and viewpoints so that you get a fuller picture of how we see the world. Today's meeting was actually a discussion, again, around Europe. It seems like we're always talking about Europe. The market started off hot this morning. I think the rumor was that was because Angela Merkel, the Chancellor of Germany, shook hands with François Hollande from France for 1.53 seconds longer than her average. And that meant all kinds of fantastic things about a higher level of agreement in Europe. Obviously, that was all made up just to try to illustrate the small, insignificant, tea-leaf reading kinds of events that seem to swing the market hundreds of points at any one time, certainly in the last 2 or 3 months. And a lot of us have been looking at Europe for a long time, and a lot of you have been asking us, what is the impact of Europe on my portfolio? And once again, you won't be surprised to hear this from us. It depends on the time frame that you look at. If you look at it over a short time frame, let's say a few minutes, the market can swing 100 points or 200 points based upon a rumor out of Europe. Over a period of several weeks, which we've seen so far this year, you can erase most of the gains that the market had seen year-to-date in 2012, although the market year-to-date is still up about 5 or 6%. But it was up much higher prior to the latest series of malcontents in Europe, making people aware that they don't want to go through with the necessary actions to resolve their budget and deficit problems. So what does that mean for all of us? Well, let's take a look at Greece as the latest flashpoint. People seem to be looking to Greece as the bellwether for all of Europe, and the reason for that is even though Greece is such a small country, and even just in Europe, let alone worldwide, it's a small impact on the total GDP, it could be the canary in the mine shaft for other countries deciding that they really don't need to follow the rules. The people in Greece are quite understandably distressed. They've seen their standard of living chopped by 25 or 30% in the last year or two. The fact that it was mostly brought on by their own refusal to pay taxes and spend within budget doesn't seem to make a difference to them. All they know is that they're having a hard time buying groceries, getting gasoline, keeping a job. And there was an election recently, which you've all probably read about, and another runoff election coming up. And in that election, a fairly dramatic offer was made by one of the candidates who came out near the top, Alex Tsipras from the Syriza party. He is a former leader of the Communist Party there in Greece, and his view is understandably very socialistic. His promise to the Greece people was that you can throw away the austerity plan, you can go back to living the way you used to live, we can have incredible labor market protections that make it hard to lose a job once you get it. We'll give you a big social safety net. You can retire at age 50 on 95% of your salary, and you don't have to follow through on the austerity plan that Europe is forcing on you. And understandably, for a certain segment, a large segment of the Greece population, that was very appealing, and therefore he gathered a lot of votes. Not enough to win outright, and that's forcing a runoff between him and the more conservative party that says, you know what, we are in a big mess, and if you think it hurts now, just wait till you see what it would be like if we're out of the European Union and back on the drachma. The impact on your quality of life would be even more dramatic and even more painful. That's a difficult message to sell, certainly from a population that has a history of not being real focused on financial discipline. So all of Europe is watching Greece. They're reading every tea leaf indication, as I said earlier, of which way they're going to vote. You'll see see a chart that I pulled out of an article today in the Wall Street Journal of a recent survey that was taken of Greek voters. And it gave them two choices really. Would you rather stay in the euro and go through the fiscal austerity plan, the very difficult budget controlling process that is being forced on us by our creditors, the rest of the European Union, or would you rather exit the euro completely and therefore not have to go through the austerity plan? At least that's the way the question was asked. The reality would force an even greater austerity on them, but that wasn't the question. And the third choice was basically, I don't know, or either one. And as you see from the chart, about 2/3 of the Greek citizens do feel a responsibility to implement the austerity plan and stay in the euro. They want to stay in the euro. So there is hope for that country. And there's a hope that they will implement the very difficult processes and policies to correct their problem. But in the meantime, everyone in the United States and around the world is watching them, and they're over-interpreting every action. And the reason they're over-interpreting, to get back to the subject, is not because of Greece, but because of what Greece might mean for the citizens of Spain. Spain is a much larger country, has a much more significant impact on European GDP, and their banks are much larger and can have a much larger impact on the financial system in Europe and around the world. And you may have read just in the last few days, a very large bank in Spain, Bankia, had to be bailed out by the government for $24 billion, a huge bailout. That bailout represents 2% of the entire country's GDP. It's a very large number. And only the beginning of the size of the problem if the entire banking system in Europe begins to see multiple defaults of countries on their sovereign debt. The banks in Europe are the largest purchasers of the bonds that are issued by the various governments, and therefore the most at risk if there were defaults on those bonds. And that could have implications for financial systems throughout the continent, and therefore a very significant impact on their GDP. That's why there is so much attention being given to Greece right now. It's the implications of their behavior on other countries. If other countries say there's an easy way out, then you could see a mass move toward that direction. And hopefully, and probably, that will not happen. Our view is with the 2/3 of the Greek citizens who realize they do have to do the hard work of fixing their fiscal house. And that's where we believe things will move. However, we have positioned your portfolios over the last year and a half to be less and less dependent upon Europe. We have reduced the number of companies that have large exposures to Europe, and we have reduced the number of preferred stocks and bonds, actually no bonds at all, that were issued in Europe, and a few preferred stocks from the two strongest banks in Europe, Deutsche Bank and Barclays, still remain. But even so, those total preferred stock holdings in your portfolios from Barclays and Deutsche Bank represent less than 1% of all of our portfolio assets at Donaldson Capital Management. So pretty manageable numbers, very strong banks. We have really no fear for their solvency, and preferred stocks are relatively liquid, so we'll be able to make changes there if we need to. And they've been providing nice returns up to that. Like I said, the exposure is below 1% on an overall basis. On the equity side, clearly the volatility in the market is affecting every one of us and affecting all of you out there. But if you think about the companies that we invest in, they are exposed to Europe primarily from the amount of product that they export to Europe. So if there is a recession in Europe, and there likely will be a recession in Europe if there isn't already, that could reduce their sales. Look at overall in the United States, only about 11% of our GDP comes from exports, and only about 11% of that is European sales. So less than 2% of our GDP is involved in European commerce. And if you think about a recession in Europe, it doesn't take their purchases from the U.S. to zero. It reduces them some level. So the potential impact on incomes is much less overall than that 2% number that I gave. And as you know, we invest in companies that sell products that are fairly essential. Staples, the industrial products that are necessary to keep the wheels moving, so of those are more volatile than others, but generally these are companies that sell some of the best products in their category, some of the market leaders, and therefore are less at risk of economic downturns. They will be affected, but not as much as the weaker companies, and certainly as a percentage impact on the overall portfolio that you hold, it will be relatively small. And on that portfolio, a couple of numbers that might be of interest to you is that so far in the last 12 months, if you look at the S&P 500 as a whole, the earnings growth over the last 12 months is about 15%, and dividend growth over the last 12 months is 12.5%. So very strong financial performance by the S&P 500 as a whole, and we like to believe that the companies we invest in, the rising dividend kinds of companies, are stronger than that average. So very solid financial performance, relatively low exposure to Europe. Where there is exposure to Europe, it is much more on the financial system risk than it is on overall economic risk and earnings risk for our companies. And I've told you how we have limited the financial risk, holding no bonds at all from European companies or countries, and only preferred stocks in a small amount from two of the strongest banks over there. And we are continually evaluating those positions as well. So if you want to know how you're exposed to Europe in the short term, you're exposed to a lot of volatility on the stock market side. You're not really exposed at all on the fixed income side. And if you take the longer term view, Europe will eventually work its way out of this mess. Our companies get the vast majority of their earnings and profits outside of Europe, and they are doing quite well. So with the longer term view, you should feel fairly confident that you can ride out this European storm without major disruptions to the march of increased value in your portfolio of rising dividend stocks. That's all for today. I hope that was helpful, and we would appreciate any feedback that you might have on these audio blogs. We're working out the kinks on them and trying to make them as useful for you as possible. Thank you.